Hello again, this is Alex with MasterChartsTrading.com, and this is Market Recap for Friday, March 18, 2016. This week we'll look at stocks which keep rising in a possible bear wedge. We'll look at some of the historical perspectives on bear market rallies. Various bond funds are at or near all-time highs. The US dollar is under pressure for the third week, and we'll look at how it ranks against the Japanese yen and the euro. I think the gold has started a new bull market, and I will lay out my case why I think that is happening. Of course, short-term gold is overbought, and we may get a pullback, same as for GDX. Oil also keeps rising in a possible bear wedge. We'll look at natural gas as it rebounds off multi-year lows, and finally we'll wrap up with sugar, which is hitting 52-week highs. Alright, this is SPY S&P 500 SPDR, kind of like the proxy for the market. So these are 52-week lows here, just in December, January and February of this year, and then since then we rebounded off the multi-year of the 52-week lows in this what I think is a rising wedge or rising channel formation. Now, while it's rising, this channel is, clearly bullish because it's rising. But I think stocks S&P 500 is actually in a bear market, and I laid out my case multiple occasions in the past. But based on the model that I'm using, I still think that S&P 500 is in a bear market. Now, this is quite a powerful rally, and many subscribers were actually asking whether or not this rally is even possible for bear markets. And next several slides we'll look at some of the historical perspectives on the bear market rallies in stocks. Now, short term here, if this is a bear wedge, I'm guessing it closed below maybe 201 here, 201 and a half or so, would probably break the wedge, this particular, the way I drew it. All our alternative, of course, we could continue higher and potentially make another all-time high. But I still don't think, even if we do make an all-time high, I don't think we're out of the woods yet. And I think the model that I'm using, my market breadth index model, will not by then flip into the bullish mode. We'll see if it does, and if it does, I have no problem looking for buying opportunities. But as it stands right now, I don't think we're there yet. We are getting a little bit of a improvement in the breadth. So like we see here a bullish divergence, which is actually a higher high in advanced decline line. So that's a positive sign, certainly. As far as the volume is concerned, I have not seen a higher high just yet. Okay, this is SPX, the actual underlying index, versus the previous one, which was SPY, which included the dividends. This index does not include the dividends. So here we actually hit a 2-year low just in February. Then, of course, we rebounded. So again, if we consider this, I actually started considering S&P 500 to be in a bear market sometime in September. So both of these rallies, one in October and the current one, I treat as a bear market rallies. You can see that this is RSI, one of the popular indicators, relative strength index, is already it was already overbought here in November. Well, close to being overbought. It actually didn't even get into the above the 70 territory, and then we had a rollover and a continuation lower. We're basically there as far as RSI is concerned, so it's possible that we will roll over here. Below here we have several of the breadth indicators I follow. percentage of stocks above the 20-day EMA. This is percentage of stocks above the 50-day EMA in red here, and percentage of stocks above the 200-day EMA in green. Now, I see here that we have improved dramatically, actually, in the percentage of stocks above the 200-day EMA department and in bullish percent index. My model does use some of the inputs that are pictured here, but the weighting of these inputs are not necessarily that high. So this, of course, is a improvement, but as far as the bigger picture, I still think that this is a counter trend rally. Now again, if we just follow this here, we can say, okay, we're definitely overbought. If we drop below like we did here on the 20-day EMA index, this could be a nice bear trigger. Hasn't happened yet, but certainly something to be on the lookout for. Okay, that's it for SPY. Okay, this is a historical chart of NYA, New York Stock Exchange Composite, and I purposely removed the time frame so as just to illustrate the point. So if we know nothing about any of the underlying breadth or anything like that, we just look at the 52-week low that we hit here, and then we had a very powerful rally. In fact, this rally of the 52-week low was 20%. And actually up here, these are at the time were all-time highs. So we approached very close to the all-time highs here. Now, if you just look at this chart and say, oh my God, this is a V reversal, maybe a W reversal. And at that point, and at this point, you're thinking, maybe I should just jump in and go ahead and, try to see if this wave continues up. Now, if we slide down below here, this is actually New York Stock Exchange Composite Index, but back in 2001. And if you follow your stock market history, you will know that this was actually the beginning of a stock market bear market in stocks. This is my market breadth index, which which called the bear market here between November, in November of year 2000. So at this point of the game, I would have considered everything that happens here from the point of view of a bear market. In other words, I would be only looking to short, and I would not be even looking to go long. So this would have been a bear market rally. Now let's see what happened after this huge rally. Let's see what happens afterwards. Okay, so this is the same chart. I fast forwarded some, and this is the same thing. Bear market rally starts here in November 2000 per my trading system here. This is the 20% rally of the lows. And then what happened? We completely rolled over and collapsed down and made fresh 52-week lows. In fact, this was already multi-year lows. So in other words, this very large, powerful rally during the bear market environment was completely reversed and then some. Going back to today's charts, let me go to today's charts now. This is NYA as it is as of the close of on Friday, March 18th of this year. So also we had a pretty powerful rally of these are actually multi-year lows as well. This is about 15% rally. And right now on Friday we are at the 200-day moving average. So if the bears are going to come in, this is certainly a good place for them to do so. So in other words, bear market rallies do happen, and they also could be quite powerful. So up days during the bear market are normal. Again, here is my market breadth index in the lower part of the chart. I started looking at only shorting opportunities here in September of last year, 2015. So both of these rallies and this rally, I'm only looking from a point of view of shorting opportunities. Alright, moving on to the bond universe. This is TLT, 20 plus year Treasury Bond Fund ETF. So these are all-time highs here just in February, and then looks like we're correcting in a sort of fallen wedge or a fallen flag pattern, basically back to the breakout levels here. Excuse me. Now we could potentially go back and forth here and maybe continue correcting somewhat more, but this is a bullish chart, 52-week highs and of course all-time highs. To me this looks very bullish, so I think once this correction has run its course, we're probably gonna break out above this kind of fallen flag and continue higher to all-time highs. In fact, the next chart, this is a weekly chart going back a couple of years. So I redrew this pattern here, and this could be like this just massive cup with possible handle that's being formed right now. If this is indeed a massive cup and handle, the depth of this pattern is 20%, and normally when you measure the potential measured move target, you measure it from the bottom of the pattern to the lip of the pattern, and add the price to the breakout level. So we could potentially continue higher significantly more for bonds. And if this is the case, we know that basically bonds and stocks correlate inversely to one another. If bonds break out to such high levels as 20% from today, most likely stocks would have been seriously corrected by then. So that's just something to keep in mind. Another bond fund, AGG. This is aggregate bond fund, which contains diversified bonds from United States bond market. Similar patterns here. We had a breakout and then all-time highs here, and I think this was a kind of like a flag consolidation and then a breakout, and these are actually again all-time highs. So we did hit a all-time high, well, by 1 cent. This is 110.29. This is 110.28. But nevertheless, this is an all-time high, and it was printed. So bonds are already breaking out to all-time highs before stocks have corrected. So maybe bonds know something that stocks do not. That's just something to keep in mind. All right, so let's move on to the dollar now. Okay, this is US dollar index. So within this pane here, in the upper pane here. So this is a chart going back 11 months, and basically it's kind of like a sideways consolidation, if you ask me. Now, the past few weeks were kind of rough for the dollar, and we had a move below this support level at 95.28. There's a small partially filled gap here, so maybe we'll get a rebound to fill that gap. But there are some interesting patterns and forces at work here. So number one, euro has been basically in a sideways consolidation as well. It's not really able to break out or break down, but back here there are 52-week lows actually. So this is more a sideways consolidation near the lows. The yen, on the other hand, is the opposite. These are actually 52-week highs, and what's interesting about that is the Bank of Japan are printing just tremendous amounts of yens, yet at the same time they are appreciating in price. And this could be due to the fact that yen is considered a safe haven currency. So again, interesting forces here. So if yen is appreciating this much, possibly the risk assets will again come under selling pressure in the not so distant future. And when I say risk asset, I meant stocks and junk bonds, of course. Moving on to the longer term picture for US dollar. So back here in 2014, we had a breakout above this level and then continuation higher. Basically, for the last year, I think we're consolidating in a sideways action, sort of. You could say that this may be a cup and handle kind of scenario. Maybe this is a falling flag of some sort. But I think that we just need to watch two levels, and the level number one is this here in pink is 100 level, and then level number two is here also in pink is at 92. So I think the breakout above the 100 or a breakdown below 92 will basically seal the fate of the dollar in the long term. A breakout would probably mean that we'll see another 9% or so move, which is a depth of this pattern, while a breakdown will most likely mean we're going to get a correction back to the breakout level for the dollar. The weaker dollar is certainly helping commodities, and the commodity that is helping the most, I think, is gold. So let's look at gold next. All right, we're looking at gold price on the daily chart going back to the early 80s. What I did is I removed the price and I only left the 50-day and the 200-day moving average in place of it. In the upper part here, we have what's called gold breadth index, which is my proprietary index, which is composed of multiple inputs related to gold and to gold miners. So what it does is it basically seeks to call a long-term bull or a bear market. So the up and down arrows here indicate entry into the bull or the bear market. From the 1984, where I have, or the 83, where I have data that's decent data, I had total of 11 major trend changes, and 10 of them turned out to be good. This was a bad signal, obviously. Most of the signals you would have been able to make some money off of them. Now, if you listen to my videos, I've been pretty vocal about the fact that I have not had enough confirmation to say that gold has entered a new bull market, but this has actually changed just this week. And one of the inputs that go into the model here, into the gold breadth index, is this raw data for the index. And finally, just today or yesterday rather, we had a bullish signal, and this final piece of the puzzle fell into place. So as of right now, I'm thinking that the new bull market on gold has already started, and I'll be basically looking for pullbacks and buying opportunities in gold. Okay, this is a weekly chart of gold going back to 2011. Down below here we have the same indicator that I just showed, the GBI, digital signal. In other words, it's either in a gold is either in a bull market or in a bear market. And here back in 2012, the indicator would have called a bear market. And then here we have another, now the entry into the bull market. And here I had marked a bunch of potential breakouts that occurred back starting 2012, and then ultimately they were all reversed and new 52-week lows occurred. This one is different, and you can see why, because you can see that this indicator did not push into the bullish territory on any one of them. So all of these rallies were counter trend rallies, and I would have considered them good short setups. In fact, we did take some short setups just last October right here with my subscribers. Now this rally looks different to me now. It looks like it's powerful enough to continue higher. Most likely a pullback of some sort will unfold, but we don't know from what level and at what time in the future this will happen. Okay, this is a gold daily chart going back 6 months. So I mentioned that we did take an opportunity here to short gold, and this was around here actually. It was pretty nice plunge to multi-year lows. Then basically at this point we have several rejection-like candlesticks and several bearish-looking, like for example, bearish engulfing pattern that did not pan out. So this was already kind of like a clue that you know, if your patterns, the bearish patterns, are not working out as well, potentially this could be already a bullish security. So you know, at this point maybe they were somewhat overbought, but again, with bullish securities, as is gold right now just became, I generally tend to ignore most of the overbought conditions and only looking for oversold conditions where I could be buying the security. So let's look at GDX next. Okay, this is GDX, MarketWax Gold Miners ETF. Same thing here. We took this opportunity and we shorted around here. But you know, GDX was really hitting this $13 area and not breaking down. Finally, it did break down, but this was clearly a bear trap. As it hit all-time lows here and then just rebounded and never looked back. So this is about 74% rally, I believe, of the all-time lows. Again, as I said before, you know, we had several bearish engulfing and rejection candles, and none of them really worked out. It just kept pushing higher. So as with gold, I'm treating GDX now as a bullish security, and again, I'm not really interested in overbought conditions. I'm more interested in oversold conditions, so I can be buying. Again, we don't know exactly when it will, pull back. It could just continue higher from here and eventually pull back, but we don't know at what time and from what level. Down below, we have gold miners breadth data. Advanced decline line, advanced decline volume line, on balance volume, gold miners bullish percent index are all looking quite good now. Since now we're basically looking at it from a point of view of a bullish security. Up to this week, I was treating these conditions as overbought. But once in a blue moon we do get a trend change, and at this time I'm treating it as a valid trend change until proven otherwise. Okay, continuing into the world of commodities, this is WTIC, West Texas Intermediate Crude Oil. Again, multi-year lows here. And then a rather powerful rally of the lows in the form of a possible rising wedge, rising channel. Now, again, this could be due to the fact that dollar has weakened, but I don't think that oil is really out of the woods yet, and I think that I don't know exactly where, because timing a short entry is quite hard, as many of you know. But I think this is still bearish, and if we just look at the rising wedge, could the rising wedge maybe a break and a close below, say, $39? Could break this wedge. So, anyways, bearish security. Basically, I'm looking for signs of failure. And once those signs are there, like for example, here with our members, we did go ahead and short it up there. It was a very nice move. There's a little bit of a bearish divergence here with unbalanced volume. I'll take it with a grain of salt though, because divergences I don't normally trade on divergences. They're just something to keep in mind. And in fact, once I get to sugar, I'll show you that those divergences don't necessarily work out. All right, that's it for oil. Okay, this is natural gas spot price daily chart. It's a little messy chart, but I'll go through it slowly so you guys can figure it out. Basically, we hit multi-year lows here in March and then rebounded. So this rebound is kind of funny looking, but it's all hollow candles basically. Here at this is a little bit of a weird candle, but for now I'll take it as is. It may get adjusted maybe tomorrow or on Monday. But in any case, this could be also a rising wedge, counter trend rally. I mean, this is a multi-year low, so the trend is clearly down. Again, same thing. We have a little bit of a divergence here, a little bit of a bullish divergence. This high here versus this high here is lower, while the unbalanced volume actually pushed somewhat higher. So something to keep in mind. Maybe this is I don't know exactly where it will fail, but for now I'm only treating it as a counter trend rally. I'm not treating it as a beginning of a new bull market. Usually, securities will go through a process of bottoming, and there will be multiple attempted and failed rallies, and then eventually it will turn around and continue higher. But for now, I'm not really seeing a major turnaround in natural gas, and I think that this is soon most likely will be a short setup. And my subscribers, we did take an opportunity here and went ahead and shorted it. And finally, this is sugar spot price daily chart. This is 52-week highs here, and this is a pretty powerful move of the lows. Now, again, this could be kind of like a beginning stages of a major trend change for the entire commodity universe, because I'm seeing some other bottoming patterns, potential bottoming patterns in maybe in coffee and maybe in copper also potentially. They haven't panned out just yet, but it's possible that a turnaround of some sort is in the making. In any case, commodities are true diversifiers for your portfolio. You have stocks, bonds, gold, maybe currency, and some commodities, because commodities really do not correlate well with any of them above mentioned ones. They do correlate occasionally, with each other. And sugar is a true diversifier, and it's a nice way to diversify away from bonds and stocks. In any case, my subscribers and we went ahead and took an opportunity around this area here, and we have a nice about 20% gain, that we're sitting at about 20% gain right now. That's it for this week's recap. Thanks for watching, and have another great trading week. Please stay tuned on how to find us on the internet. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial, and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of risk control, as well as just the psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change, The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. You have Twitter, Facebook, YouTube stacked with accounts. You can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching, and have another great trading week. Bye bye.